Hello friends, I am CA-SK Chhabra taking the topic Accounting Process, Chapter 2. Let us see certain concepts with the help of which we can pass different journal entries and the rules and regulations of debit and credit. There are basically two approaches for journal entries. There are two approaches for all the journal entries which we pass, not only in India but all over the world itself. First approach, we take it as modern approach. Its other name is American approach also. अमेरिकन अप्रोच, इसको हम यूएस अप्रोच भी कहते हैं. एंड सेकंड इज which we say as traditional approach. इसको हम British approach भी कहते हैं. These two approaches are used with the help of which we can pass all the journal entries. So firstly, we will discuss the modern approach. As per the modern approach, all the accounting items are divided in 5 ways. Accounting items are divided in 5 ways. Firstly, assets. Second, expenses. Third, liabilities. Fourth, capital. And fifth is revenue. Let us discuss what assets is all about, what is expenses, what is liabilities, capital and revenue. Let us see briefly what these items means. If I say assets, assets refers to anything of value owned by the business. Anything of value owned by the business. Anything which possesses any value and it is owned by the business, we will take it as asset. For example, pen, computer, stock, furniture. If it is owned by the business, then it implies it is an asset for the business itself. If I take example, stock, cash, computer, machine, these are nothing but asset for the business. So asset is nothing but anything of value owned by the business. Then I will take expense. What does expense means? Expense refers to any amount spent against which business get certain benefit. So expense refers to any amount spent against which business gets certain benefit. Sometimes it may happen that the business get greater amount of benefit, and sometimes it may happen the business does not get that much amount of benefit. But with the help of any type of expense, business will get certain benefit. It may be of lesser amount or it may be of greater amount. Example, salaries paid, rent, etc. Then I will see what liabilities is all about. Liabilities refers to any amount which business owes to outsiders. So liabilities means any amount which business owes to the outsiders. In accounting, when we talk about owes, it implies liability. In accounting, when we talk about the term owes, it implies liability. See, when we do accounting, we always take into account that business is separate, owner is separate, and we do accounting from the point of view of business. So any amount which business has to pay to the outsiders, then it is a liability for the business. So in whole accounting, whenever there is a term owes, it implies liability. Then next we will take it as capital. What does capital means? Refers to any amount which business owes to the owner, or I can say any amount which, or I can say any amount which owner has invested in the business. So capital is nothing but any amount which owner has invested in the business, or any amount which business is supposed to pay to the owner. And then lastly, it is revenue. Revenue refers to any amount received by the business. It may be received or receivable by the business from sale of goods or sale of services or rent receipt or interest received or dividend received, etc. Revenue is nothing but any amount which business will receive from the sale of goods, sale of services, rent received, interest received, or dividend received. In case of any business, whatever amount they receive from doing the business, we term it as a revenue. Because if we sell the goods, whatever amount we receive, it is not the profit for the business, but it is nothing but a simple revenue. If any business sells a certain scrap goods or get certain miscellaneous income from sale of certain scrap material or sale of newspaper, something like that. It is nothing but a revenue for the business. It's not a profit. So profit we get only when we decrease expenses from the revenue. So these are the 5 things which normally we use as per modern approach. And the rules for debit and credit and rules of debit and credit for this approach is, for assets oblique expenses, there is one rule, that is debit for increase and credit for decrease. So whenever there is increase in assets or increase in expenses, we will always debit it. And whenever there is decrease in expenses or decrease in assets, we will always credit it. So this is a simple. For liabilities, capital and revenue, there is one rule, that is debit for decrease and credit for increase. So whenever there is decrease in liability or decrease in capital or decrease in revenue, we are supposed to debit it. And whenever there is increase in liability, increase in capital or increase in revenue, we are supposed to credit. So these are the rules which we follow when we use modern approach for finding out the journal entries. So let us see in concise way what traditional approach says. As per traditional approach, all the items are divided in 3 ways. First, personal account. In personal account, it is divided as natural personal account, it is divided as artificial personal account, then representative personal account. Personal account implies when any account is related to specific persons. Then it is bifurcated into whether it is a natural personal account, representative personal account, or artificial personal account. For example, when I take Mohan, Gopal, they are included in natural personal account because they are made by the Almighty, so they are natural personal account. Then artificial personal account. Artificial personal account. Example, Mohan Limited, because it is a limited company registered under the Companies Act 1956. Now the new Companies Act 2013 has come. So Mohan Limited is artificial personal account. Gopal Limited, again artificial personal account. Mohan and Company Chartered Accountant. Mohan and Company Chartered Accountants, again an artificial personal account. Then representative personal account. Then representative personal account. All the representative personal account example. See, it's very simple. In case of all the representative personal account, all items related to outstanding expenses, outstanding income, prepaid expenses and income received in advance are included in representative personal account. I repeat, all types of outstanding expenses, outstanding income, prepaid expenses, income received in advance is included in representative personal account. Example, outstanding salaries, prepaid insurance, outstanding income, then any type of income received in advance. Income received in advance. It is included in the representative personal account. See, one thing you should always note that sometimes we feel that whether this account is a personal account or not. Very simple thing you should always keep in your mind. All the items which are shown on the liability side of the balance sheet always are included in personal account, like share capital, loans, all the current liabilities are included in the personal account. See, only personal and real account are shown in the balance sheet because nominal account is not shown in the balance sheet, it is always shown in the income statement. So on the liability side of the balance sheet, we show only personal account. So we have seen the natural personal account, artificial personal account and representative personal account. Their rule is rule of personal account. Debit the receiver. Rule of personal account, debit the receiver. Credit the giver. Then we will see real account. It includes the following. What? All fixed asset. All investments. Stock, cash. Only these type of items are shown in the real account. And real account is always shown on the asset side of the balance sheet because real account we do not show on the liability side. The rule of real account is debit what comes in, credit what goes out. Debit what comes in and credit what goes out. So it is a rule itself. One thing you should always take into account, only assets are included in real account. Only assets are included in real account, so liabilities are not shown in it. Now let us see the nominal account. Nominal accounts are related to all expenses, income. Nominal account is not shown in the balance sheet. It is always shown in the income statement. Nominal account is not shown in the balance sheet, but always shown in the income statement, which we say it as a profit and loss account. This account is related to all expenses and income. Rule of nominal account. Debit all expenses. Debit all expenses. Expenses and losses. Credit all income and so let us see the first question. Journalize the following transaction. Also state the nature of each account involved in the journal entry. Transaction first. Ajit started business with. Let us see the first transaction. Ajit started business with cash, rupees 40,000. So we know that business is separate, owner is separate, and owner is Ajit and started business with cash, rupees 40,000. Second transaction is on December 3rd, he paid into bank rupees 2,000. So amount is deposited into the bank. Third transaction is on 5th December, he purchased goods for cash, rupees 15,000. Fourth transaction is on December 8th, he sold goods for cash, rupees 6,000. And fifth transaction is on December 10th, he purchased furniture and paid by check rupees 4,000, 5,000. So let us see the solution and the questions which we have seen in the question. There were 5 transactions. We will see its solution with concept itself. In the first transaction, Ajit started business with cash. Started business with cash, rupees 40,000. He started business with cash, rupees 40,000. We know business is separate, owner is separate. So if we let us see the rules of modern approach, so there are 2 things. First is cash and second is capital, because Ajit is the owner and owner invests certain amount in the business, that is nothing but the capital. So when rupees 40,000 is invested, rupees 40,000 cash is increased in the business. We know the rules of debit and credit as per modern approach. Cash is asset and capital, we know it is a personal account and it is a it also fit in the having a separate head itself. It's capital. So cash is an asset. Whenever there is increase in the asset, it is debited. So cash account debit. And when Ajit invested certain amount in the business, it is capital. So there is increase in capital also. So whenever capital increases, it is credited. So cash account debit to capital account. How much is the amount? 40,000. The amount is 40,000. So in case of first transaction, so Ajit is the owner. He started business with rupees 40,000. So in the business, cash has increased. Cash is an asset. Whenever cash increases, asset is always debited. So cash account is debited, and in the simultaneously, the capital invested by the owner is also increases. When the capital increases, then also we credit the capital account. So capital account is credited. So in the first transaction, the journal entry is cash account debit to capital account. Cash is an asset. It is debited due to increased capital. It is a separate head. Whenever it will increase, it is credited. Second transaction was he paid into bank rupees 20,000. Ajit paid rupees 20,000, rupees 2,000 in bank. So the accounts involved is one is cash, one is bank. Cash is an asset, bank is an asset. When we deposit cash, cash is decreased, and when we deposit the cash into the bank balance is increased. So when we deposit cash into the bank increases, bank is an asset. Increase in asset is always debited. So bank account debit to cash account. The amount is 2,000. Amount is 2,000. Let us see the third transaction. He purchased goods for cash 15,000. So third transaction is goods purchased for rupees 15,000. Goods purchased for rupees 15,000. See, in this case, goods refers to those items which are purchased for the purpose of sale. So goods are purchased, we use the term purchases. Purchases is a nominal account because when we purchase the goods, it is an expense for the business, and we purchase the goods only for the purpose of sale itself. So when goods are purchased, it is an expense for the business, and whenever there is increase in expense, so account is debited. So whenever goods are purchased, we debit purchases account. And goods are purchased for 15,000, so it is obvious that we are paying 15,000 in cash. When cash is paid, cash is an asset. So when asset decreases, it is always credited. So purchase account debit to cash account 15,000 and 15,000. Let us see the fourth transaction, which is done on December 8. He sold goods for cash rupees 6,000. So goods sold for rupees 6,000. So when we sell the goods, sales is a nominal account because goods refers to those items which are purchased for the purpose of sale. So when the goods are sold, it is a revenue for the business. So when the revenue increases, it is always credit. So in this, two items are involved. First is cash. We will be receiving cash for the sale as name of the party is not given. And the second is sales. Sales is nothing but revenue and cash is nothing but asset. So when we will be selling the goods, cash will be received. So cash is an asset. When asset increases, it is always debited. So what we will do, cash account debit due to increase, and sales also increases, so revenue will also increase. When revenue is increased, it is always credited. So the journal entry will be cash account debit to sales account. The amount is 6,000. We will see the next transaction. He purchased furniture and paid by check 5,000. On December 10th, he purchased furniture and paid check for it, and the amount of check is 5,000. Furniture is a fixed asset, so two accounts involved is furniture and bank account. Furniture is a fixed asset. Whenever asset increases, it is always debited. So furniture is an asset, bank is also an asset. Furniture is increasing, and when we will pay by check, the bank balance will decrease. So increase in asset is debited. So entry will be furniture account debit, and when we will pay by check, it is a bank account, bank balance decreases, so it is credit. Furniture account debit to bank account, the amount is how much? 5,000. Let us see the other transaction. 6th. On December 12th, he sold goods to Arvind, 4,000. On December 14th, he purchased goods from Amrit, rupees 10,000. On December 15th, he returned goods to Amrit. You can see. On December 14th, he purchased goods from Amrit, rupees 10,000. So goods are purchased from Amrit. It is a credit purchase worth rupees 10,000. On December 15th, he returned goods to Amrit. So in the 7th transaction, goods were purchased. In the 8th transaction, goods are returned to the Amrit. Then on December 16th, he received from Arvind rupees 3960 in full settlement. So amount is received from Arvind rupees 3960 in full settlement, because on December 12th we sold goods to Arvind for 4,000 and we are receiving 3960, so it's obvious that 40 rupees is the discount. On December 18th, he withdrew goods for personal use, rupees 1,000. So these are the 5 transactions we will take into account. Answer 1 is continued. So we will see the 6th transaction. He sold goods to Arvind. So he sold goods to Arvind for rupees 4,000. Name of cash is not given, so we will assume it to be a credit sales. So 2 accounts are involved. One is Arvind, second is sales. Arvind is a debtor, Debtor is nothing but asset and sales is revenue. Debtors is increasing and sales is also increasing. So when we sell goods to the Arvind, our debtor will increase by 4,000, and debtor is an asset. Whenever there is increase in the asset, it is always debited. So we will debit the account of the Arvind. Arvind account debit 4,000, and sales is a revenue. Whenever there is increase in the revenue, it is always credited. So we will write to sales rupees 4,000. Now let us see the seventh transaction. Let us see the seventh transaction. He purchased goods from Amrit for rupees 10,000. Goods are purchased from Amrit, so two things are involved. First is Amrit account and other is purchases. So two things are involved, Amrit and purchases. When we are making the credit purchases, as name of cash is not given but the name of the party is given. So when we make credit purchases, so our liability increases. So Amrit is a creditor. It is a liability for the business and it increases. Purchases is an expense and expense also increases. So we know whenever expense increases, increase in expenses debited. So what we will do, purchases account debit to Amrit account, because Amrit is a liability for the business. Whenever there is increase in the liability, liability always is credit. So purchases account debit to Amrit account, amount is 10,000 and amount is 10,000. So let us see the eighth transaction. Let us see the eighth transaction. He returned goods to Amrit. He returned goods to Amrit. Previously goods were purchased, now they are returned. For how much amount? Rupees 5,000. So two things are involved. First is Amrit is a liability, and other thing is when goods are returned, so it is a purchase return. Purchase return is an expense. Whenever expense is reduced, it is always credited. So purchase return is credited. By how much amount? That is 5,000. And Amrit, we have purchased the goods, we are returning to the Amrit, so our liability also decreases by 5,000. Whenever there is a decrease in the liability, it is always debited. So what we will do is Amrit account debit to purchase return. The amount is how much? Rupees 5,000. Let us see the ninth transaction. He received from Arvind rupees 3960 in full settlement. So he received the amount from Amrit. How much amount? Rupees 3960 in full settlement. We know that we sold the goods to the Amrit for rupees 4000, which was 6th transaction, and we are receiving rupees 3960. So it is a discount of rupees 40. So we are receiving the accounts involved is cash. Cash is an asset. Asset is there is increase in the asset. Then there is a discount because instead of 4000 we are receiving 3960. So there is a discount of rupees 40. So discount is an expense. Expense is also there is an increase. And we are receiving from Amrit. Amrit was the debtor for the business, and we know debtor is an asset, and our asset will decrease, then we will receive the amount. So when we will be receiving the amount, cash is an asset, cash will increase. So on increase of asset, the account is debited. So cash account is debited by 3960. We are allowing the discount. Discount is an expense. Increase in expense is also debited. So discount account debited by 40. Then we are receiving the amount from Amrit. Amrit is a debtor. When we will receive the amount, our debtor will decrease. So when asset decreases, it is always credited. So it is to Amrit. Amount will be 4000. So let us see the 10th transaction. He withdrew goods. So he withdrew goods for personal use. Goods for personal use. Rupees 1000. So two counts are involved. When any goods are withdrawn from the business, the amount of purchases decreases, and if it is withdrawn by the owner, then amount of capital is also decreased. Because when goods are withdrawn, it is a sort of drawings, and drawings is nothing but reduction of capital. So two counts involved are drawings. Drawings is nothing but related to capital, and it decreases. Other is goods. So whenever there is outflow of goods, we always use the term purchases. So the other account is goods, but when we have purchased the goods, we use the term as purchases, and it is a expense for the business, and our expense also decreases. So when goods are withdrawn, capital is also reduced. Reduction in capital is always debited. So instead of using the capital account, we use the term as drawings account. So drawings account is debited. And whenever there is outflow of goods at a cost, we always use the term as purchases. So entry will be drawings account debit to purchases account, rupees 1000 and rupees 1000. Let us see the other points. 11th transaction. On December 20th, he withdrew cash from business for personal use, rupees 2000. On December 24th, he paid telephone charges, rupees 1000. On December 26th, cash paid to Amrit in full settlement, rupees 4900. On December 31st, paid for stationery rupees 200, rent rupees 500, and salaries to staff rupees 2000. Then again on December 31st, goods distributed by way of free samples rupees 1000. Let us see the 11th transaction. Cash withdrawn from business for personal use. Cash is withdrawn from the business for personal use. How much is the amount? 2000 rupees. 2000. So two things are involved in this transaction. First is cash. Cash is an asset and cash is withdrawn, so amount of cash is decreased, and it is for personal use, so it is a drawings. Drawings is something related to capital, and when drawings takes place, capital is decreased. So we know whenever asset is decreased, it is credited. So cash account will be credited. And whenever there is a decrease in capital, it is debited. So instead of using the term capital, we use the term as drawings. So our entry will be drawings account debit to cash account. Amount is how much? 2000. The 12th transaction. He paid for telephone charges. He paid for telephone charges. How much amount he paid? Rupees 1000. Telephone is an expense, so it is paid in cash itself. So things involved is, first is cash. Cash is an asset and asset is decreased. Other is telephone. Telephone is nothing but telephone charges is an expense, and when we will make the payment, our expense increases. So when we pay the telephone charges, our expense increases. So increase in expense, we know it is always debited. So what we will do is telephone expense account debit to cash account. Cash is an asset. Whenever there is a decrease in asset, it is always credited. So cash account is credited and telephone expenses debited. One thing we are supposed to keep in our mind, in case of any type of expense, we always use the name of the expense. So when there is increase in expense, we always debit the name of the expense, and when there is a decrease in expense, we always credit name of the expenses. So let us see the 13th transaction which we have seen. Let us see the 13th transaction. On December 26th, cash paid to Amrit in full settlement of rupees 4,900. Let us see the solution of 13th transaction and what 13th transaction say all about. In case of 13th transaction, cash paid to Amrit rupees 4,900 in full settlement. So two accounts are involved. First is cash. Second is we are paying to the Amrit. So Amrit is a liability. And we are paying cash. Cash is an asset. In the past transaction which we have done, we purchased goods worth rupees 10,000 from the Amrit and we returned goods worth rupees 5,000 to the Amrit. So balance rupees 5,000 was payable, but we are paying 4,900 in full settlement. So it implies we are receiving certain amount of discount also. So discount we are receiving, it is a income which we can also say as revenue. So cash we are paying, cash when we make the payment, so asset will decrease. When we are making the payment to the Amrit, our liability will also decrease. So when we will make the payment, we will receive the discount. So our revenue will increase. As per modern approach, when cash is an asset decreases, decrease in asset is always credited. So we will credit cash account. How much amount we are making the payment? 4,900. We are making the payment to the Amrit. Amrit is a liability. So whenever liability decreases, it is always debited. So Amrit account will be debited. Amrit account debit. How much is the amount? The amount was 5,000, but we have paid just 4,900 in full settlement because this transaction is related to past transactions which we have done for Amrit. So discount we are receiving. One thing we should always keep in our mind, in case cash is credited, discount is always credited. If cash is debited, discount is always debited. We will discuss why this happens. When cash, we are making the payment, so we receive the discount. When we are receiving the discount, it is an income. So increase in income or revenue is always credited. So when we are making the payment of 4,900 instead of 5,000, we are receiving a discount of 100. 100 is a revenue or income for the business. Increase in revenue is always credited. So it is a discount received. So what we will credit is discount received account credited, that is rupees 100 itself. One thing we should always keep in our mind, whenever any type of expense takes place, whether it is increased or decreased, or any income is received or it is repaid, we always debit or credit name of the expense or name of the income. Now we are receiving the discount, we will always use the name of the income which we are receiving. So we use the term as discount received. So the net impact is Amrit account debit 5,000, to cash account 4,900, to discount received account rupees 100. So let us see the 14th transaction. On December 31st, paid for stationery rupees 200, rent rupees 500, and salaries to staff rupees 2,000. So as all these transactions has taken place on December 31st and their nature is also same, so we can also pass the compound entry. So we can use the compound entry. So let us see the 14th transaction and its solution. The journal entry we are supposed to pass, the transaction was related to expenses. On December 31st, stationery expense paid rupees 200. So stationery paid rupees 200. Then rent paid rupees 500 and salaries to staff we have paid rupees 2,000. As all these accounts are related to nominal account, so we can pass a single compound entry. So amount is paid, so account involved is, one is cash. Cash is an asset. And other is expenses. Cash is an asset. Second is expense. Expense, the head, we know it is expense itself. There are three types of expenses: stationery, rent, and salaries. Whenever there is decrease in asset, it is always credited. So decrease in asset is always credited. And whenever there is increase in expense, it is always debit. One thing we should always keep in our mind, that whenever any type of expense takes place, we always debit name of the expense. Even if we are paying salaries to staff or to any low MD itself, whatever to whom we are making the payment as salaries, we will always debit the name of the expense. For example, we are making the payment to Gopal as salary. So we are not concerned with Gopal. We are concerned with the name of the expense, that is salary. So we will be using the term as salaries. So in all these cases, stationery paid, rent paid, or salaries to staff, we will be using the term, the name of the expense. So what we will debit is, so when we pass the entry related to any expense, we always debit the name of the expense. So in this case, as all these entries are made on December 31st, what we will do is stationery account debit, rent account debit. Whenever any same type of accounts are debited in the same entry, we take it as a compound entry. As the nature of all the entries is related to nominal account, so stationery account debit 200, rent account debit 500, salaries account debit 2000 to cash account. So total amount comes out to be 2700. As there is a decrease in cash, so cash account is credited, and there is increase in expense, so expenses account are debited in this entry. Let us see the 15th transaction. On December 31st, goods distributed by way of free samples, rupees 1000. In case of 15th transaction, goods distributed by way of free samples, 1000. So when we give the free samples, it is for the sake of advertisement. It is for the sake of advertisement. So when we are giving free samples, it is included in the expense known as advertisement. Advertisement is an expense, and when we do advertisement, our expenses increased, and increase in expenses always debited. One thing we should always keep in our mind, whenever there is outflow of goods, we know goods is nothing but any item which is purchased for the purpose of sale is a goods. Whenever there is outflow of goods, we always use the term as purchases. When there is an outflow of goods at cost or free of cost, we always use the term as purchases. But when we are selling the goods, then we use the term as sales. In case of advertisement, we are giving free samples. So there is an outflow of goods totally at free of cost. So we will be using the term as purchases. So it is nothing but decrease in the amount of expense. So here expense is decrease, and we know decrease in expenses nothing but credit. So we will take into account the journal entry itself. December 31st, as there is increase in the expense, advertisement Account debit to purchases. The amount is how much? Let us see the question 2. Show the classification of the following accounts under traditional and modern approach. First is building. B is purchases. C is sales. D is bank deposit. E is rent. F is rent outstanding. G is cash. Then adjusted purchases. I is closing stock. J is investments. K is trade receivables. Then L is sales tax payable. M is discount allowed. N is bad debt. And O is capital. In case of building, it is a real account because real account, all the fixed assets are real account as per traditional approach. As per modern approach, it is an asset. So building is a real account. If we take traditional approach, it is an asset. If we take the modern approach, then purchases. If we take as per traditional approach, it is a nominal account. If we take as a modern approach, it is an expense. Sales. As per traditional approach, it is a nominal account. But if we take as a modern approach, it is a revenue. Then bank deposit. As per traditional approach, it is a personal account because bank deposit is always in name of certain person. As per modern approach, it is an asset for the business. Rent is a nominal account. It can be expense, it can be income. As per modern approach, if it is an expense or it can be income also. So I'm taking it as expense. Rent outstanding. As per traditional approach, it is a personal account. Personal account of which type? Representative personal account. Personal account of which type? Representative personal account. And as per modern approach, it is a liability for the business. Cash. Cash as per traditional approach, it is a real account because we can touch cash. But as per modern approach, it is an asset. Then adjusted purchases. As per traditional approach, it is a nominal account. But when we take as modern approach, it is an expense. Closing stock. It is as per traditional approach. It is a real account because we can touch. As per modern approach, it is a asset. Investments. As per traditional approach, it is a real account if it is made in fixed asset. As per modern approach, all investments are assets. Trade receivables. It is a personal account as per traditional approach. As per modern approach, it is an asset. It is amount receivable, so asset for the business. Sales tax payable. It is a liability for the business. As per traditional approach, it is a personal account because all liabilities are personal account. As per modern approach, it is a liability. Discount allowed. As per traditional approach, it is a nominal account. As per modern approach, it is a expense. Bad debt is a loss for the business. As per traditional approach, it is included in nominal account. As per modern approach, it is an expense. Capital. As per traditional approach, it is a personal account. And as per modern approach, we are having a separate head, that is capital itself. Continuing the question 2 itself, we are supposed to specify traditional, as per traditional approach and modern approach, drawings, then interest receivable account, then rent received in advance account, then prepaid salary account, then bad debts recovered account, then depreciation account, then personal income tax account. Now we will see point P itself, drawings. Drawings is nothing but reduction of capital. So drawings is nothing but reduction of capital. So as per traditional approach, we know capital is a personal account. So drawings is nothing but the personal account. As per modern approach, drawings is reduction of capital, so included in capital account. So let us see the Q point itself. Interest receivable. It is an asset for the business. Interest receivable is an asset for the business. So we know in case any amount is receivable from someone, it is always related to personal account. To be very precise, it is related to the representative personal account. So interest receivable is nothing but simple personal account. So as per modern approach, it is an asset for the business. So interest receivable is nothing but the asset. Rent received in advance, R point. That is rent received in advance. So if we take the rent received in advance, it is a liability for the business. So we know all the liabilities are nothing but simply personal account. So as per traditional approach, rent received in advance is a personal account. To be very precise, it is a personal account of representative nature. As per modern approach, it is a liability. So we will take into account the liability. Prepaid salary. So as per traditional approach, it is a personal account. To be very precise, it is representative personal account. But as per modern approach itself, it is an asset for the business. So prepaid salary is nothing but asset for the business. Let us see the T transaction, bad debt recovered. It is an income for the business. So all the incomes are related to the nominal account. Bad debt recovered, it is nothing but previously it was bad debt but recovered afterwards by the business. So as per traditional approach, bad debt recovered is nothing but included in nominal account. And as per modern approach, it is an income for the business and included in the revenue of the business. Next, we will see the depreciation. Depreciation is an expense for the business. So as per traditional approach, depreciation is included in the nominal account. So as per modern approach, depreciation is an expense, included in expense. Then let us see the personal income tax. Personal income tax is paid on the profit earned. As we know, profit is added to the capital account. So personal income tax is nothing but a simply drawing a reduction of capital. So personal income tax is a personal account as per traditional approach, and as per modern approach, it is included in the